Here's something they won't tell you on the evening news. Right now, as you're watching this video, the largest economic experiment in modern history is failing in real time. And I don't mean failing quietly. I mean producing the exact opposite results of what was intended. The kind of failure that makes you question everything you thought you knew about how global economics actually works. But here's what makes this absolutely wild. The people running this experiment, they're doubling down, tripling down, actually, and every time they push harder, the results get more unpredictable. It's like watching someone try to put out a fire with gasoline, realize it's not working, and then deciding the solution is more gasoline. I'm going to show you 3 interconnected crises that are unfolding right now. Not next year, not in some distant future, right now. And by the end of this video, you're going to understand why your cost of living is about to get significantly worse, regardless of what any politician promises you. More importantly, you'll see exactly why that's happening, which means you can actually prepare for it instead of being blindsided like most people will be. So let's start with a simple question that should make you uncomfortable. What happens when the world's most powerful economic alliance, with unlimited resources, unlimited intelligence capabilities, and decades of experience, throws everything they have at destroying an adversary's economy? And 3 years later, that economy is not just surviving, but showing clear signs of structural adaptation. You'd probably think I'm exaggerating. You'd assume that surely the sanctions are working, we just don't see it yet. The collapse is coming, it's just around the corner. That's what we've been told for 3 years straight. Any day now, any week now, the currency will collapse, the banks will fail, the people will revolt. Political change is inevitable. Except none of that happened. And the longer we pretend it's about to happen, the more we miss what's actually occurring, which is far more interesting and honestly more concerning than a simple economic collapse would be. Let me paint you a picture with actual numbers, because numbers don't care about narratives or political spin. Russian oil exports, right now, at this very moment, are moving at over 4 million barrels per day. Now, pause and think about that. We're 3 years into what was described as the most comprehensive, coordinated sanctions regime ever assembled in human history. Every major Western economy is participating. The legal architecture spans thousands of pages. Entire government departments are dedicated to enforcement. And yet, oil is flowing at levels we haven't seen in 3 years. You know what that sounds like to me? That sounds like the economic equivalent of declaring victory while losing the battle. But it gets so much more interesting when you dig into the details, because this is where the real story lives. Yes, Russian oil is selling at a discount, about $27 per barrel below global benchmark prices. And if you stop your analysis there, you'd conclude the sanctions are working. Russia is losing revenue. They're being punished. Mission accomplished. Except that's not where the story ends. That's barely where it begins. Track that oil on its journey. It leaves Russian ports at a $27 discount. Huge hit to revenue, right? But then watch what happens. That same oil arrives in India, and suddenly, mysteriously, the discount has shrunk to just $7.50 per barrel. So we have to ask the obvious question. Where did that missing $20 go? Did it evaporate? Did it disappear into thin air? Of course not. Money doesn't vanish. It just changes hands. And this is where the entire sanctions architecture reveals its fundamental flaw. That $20 gap is getting split up among a fascinating cast of characters. Shipping countries refuse, where new logistics networks can be built surprisingly fast, where financial infrastructure can route around blockages. In this world, sanctions don't stop activity, they redirect it. And that redirection creates winners and losers in unexpected places. India wins enormously. Shipping companies win. Trading firms win. And yes, Russia loses some revenue, but nowhere near the catastrophic loss that was intended. They've adapted. The war continues. The economy functions. And every month that passes, these new trade routes become more established, more efficient, more permanent. But here's where the story takes a turn that I genuinely find fascinating. Oil is only the first pillar of this economic pressure campaign. The second pillar was supposed to be currency warfare. And this is where things get truly counterintuitive, where the results are so opposite of what was intended that you'd almost think it was deliberate. The stated goal was explicit, crystal clear: reduce the ruble to rubble. Those were the actual words used by officials. The strategy was to make the Russian currency worthless, create hyperinflation, trigger bank runs, cause financial panic so severe that the domestic population would demand change. Currency collapse has toppled governments before, it's destroyed economies, it's caused revolutions. So the theory was sound, based on historical precedent. What actually happened is going to sound impossible if you've been following mainstream coverage. The ruble has strengthened by 45% against the dollar year to date. 45%. Not weakened, not collapsed, strengthened. The currency is almost back to pre-war levels. If someone showed you a chart of ruble performance over the past year without any context, you would naturally assume that sanctions had been lifted, that trade had normalized, that everything was back to business as usual. Now, before you jump to conclusions, let me explain why this is happening and why it's more complex than either sanctions failed or sanctions worked. Because reality, as usual, is more nuanced than the simple narratives we're fed. First, let's address the obvious question. Isn't a stronger currency bad for an export-dependent economy? In theory, yes. When your currency appreciates, your exports become more expensive in foreign currency terms. If you're selling oil priced in rubles and the ruble strengthens, foreign buyers need to spend more of their currency to buy the same amount. You should sell less. For most commodity exporters, this would be a serious, possibly fatal problem. But Russia's situation has specific characteristics that change this calculation entirely. Their primary export, energy, is already selling at a substantial discount to global prices. We just talked about that $27 discount. When you're offering oil significantly below market rates, buyers aren't particularly sensitive to currency movements. They're still getting a deal compared to buying from Saudi Arabia or the United States. The currency strength doesn't price them out of the market because the underlying discount is so large. So the theoretical disadvantage of a strong currency, reduced export competitiveness, is largely offset by the discount structure that's already in place. But the advantages of a stronger ruble, those are very real, very substantial, and often completely overlooked in Western analysis. A stronger currency makes imports cheaper. Think about what that means for an economy trying to modernize and diversify. Industrial inputs, the raw materials and components needed for manufacturing, become more affordable. Machinery and technology critical for building up domestic industries can be purchased more efficiently. This isn't trivial. This is the foundation. Trade outside the dollar system, where alternative payment networks have been built specifically to avoid Western financial infrastructure, currency-based sanctions lose much of their power. The ruble's strength isn't just about Russian central bank policy or capital controls. It's evidence of a broader structural shift in how international trade is conducted. And this brings us to the third crisis, the one that I think will define 2026 and possibly beyond. This one is just getting started, but the early warning signs are everywhere if you know where to look. We're heading into what I believe will be the most consequential commodity war in modern history, and the epicenter of this battle is copper. Now, you might have heard about the silver squeeze. Physical silver demand in China has been so intense that prices there are trading 10% above global markets. That's not normal market behavior. That's either panic buying or strategic resource accumulation on a massive scale. But silver, as dramatic as that situation is, was just the opening act. The real show is moving to copper, and the implications are staggering. Copper prices in China just hit a new record. We're talking about prices jumping 4.7% in a single move to nearly 100,000 yuan in New York. The supply situation is even tighter. Prices climbed 5.6%. These aren't normal market fluctuations. This is confirmation of what many analysts have been warning about for months. A full-scale commodity war is coming, and copper is ground zero. So why copper? Why is this metal suddenly at the center of great power competition? Because copper is genuinely irreplaceable in modern civilization. You cannot build infrastructure without it. You cannot manufacture electronics without it. You cannot construct power grids without it. You cannot build electric vehicles without it. And most critically for what's coming, you cannot construct data centers without absolutely enormous amounts of it. And right now, today, both the United States and China have simultaneously decided that securing copper supply is a matter of national economic security. When the world's two largest economies with essentially unlimited resources compete for a finite commodity, what happens to prices? They don't just increase, they explode. And everyone else in the world gets caught in the crossfire. Let me walk you through the timeline of how this is unfolding, because understanding the sequence of events helps you see where this is heading. China has explicitly made domestic economic growth their #1 priority for the coming year. That's not rhetoric, that's actual policy. Domestic growth means infrastructure spending, it means construction, it means massive industrial activity, all of which requires enormous copper consumption. The United States, meanwhile, is quietly but aggressively stockpiling copper while simultaneously backing major domestic production projects. The U.S. government is supporting a $7.4 billion smelter in Tennessee. That facility will produce copper along with zinc, lead, and precious metals. $7.4 billion. That's not a small investment. That's a strategic initiative to build domestic supply chains that don't depend on any potential adversary. Now here's what makes this urgent and honestly scary for everyday people. Data centers. The artificial intelligence boom isn't slowing down. If anything, it's accelerating. Hundreds of billions of dollars are being committed to AI infrastructure by every major tech company. Microsoft, Google, Amazon, Meta, they're all racing to build computing capacity. Where does all that capital actually go? Into physical data centers, buildings full of servers and cooling systems and power distribution. And what do data centers require in truly enormous quantities? Steel for the structure, aluminum for various components, and especially copper. Copper for the wiring, copper for the power distribution, copper for the cooling system. Necessary to secure copper supply. So, what does all of this mean for you personally, for your life, your finances, your plans? Higher inflation is coming. Not maybe, not possibly, it's coming. The cost of building anything is going to increase substantially. Housing, which is already unaffordable for massive portions of the population in most developed countries, is going to get worse. Construction costs will rise, manufacturing costs will rise across the board. And all of those costs, every single one, gets passed down to consumers eventually. If you thought the inflation of 2021 and 2022 was painful, and it absolutely was for most people, the commodity-driven inflation potentially coming in 2026 and beyond could actually be worse in certain sectors. It might not show up in the overall CPI the same way, but in construction, in electronics, in anything requiring significant copper input, prices are going to climb. And here's the really difficult part. Neither the United States nor China can back down from this competition. It's not optional for them. Both governments see technological leadership, particularly in artificial intelligence, advanced manufacturing, and green energy, as essential to their future power and prosperity. Copper is the literal physical infrastructure that makes all of that technology possible. It's the foundation. Without secure copper supply, you cannot build the future both countries envision. So both will keep buying, both will keep building, both will keep securing supply regardless of short-term cost. They'll outbid each other, they'll pay premiums, they'll offer political concessions to supplier countries. And everyone else in the world, all the smaller economies, all the everyday consumers, will pay the price through higher costs for everything that contains or requires copper. This is also why, and this is important for anyone thinking about their financial future, the US dollar will continue to face structural pressure. The US government is going to spend truly enormous amounts securing these commodity supply chains. That spending has to come from somewhere. It comes from deficit spending. It comes from money creation. It comes from expanding the money supply. That's dollar debasement by definition. U.S. Treasury bonds, which are supposed to be the safest, most reliable asset in the world, the foundation of the global financial system, the mathematics are starting to look questionable when you factor in the spending required to compete in this new era. I'm not saying bonds will collapse or the dollar will disappear, but the assumption that they're risk-free, that they're automatically the best store of value, that assumption is worth questioning when you see the spending commitments being made. Before we wrap this up, if this analysis gave you a perspective you haven't seen anywhere else, if it connected dots you didn't even know were there, please hit that like button and consider sharing this video. This kind of deep research content takes significant time to put together. Your engagement directly helps more people discover this information and tells me that this detailed approach resonates with you. Let me bring all three of these stories together because they're not separate phenomena. They're part of one larger transformation that most people don't see happening. We're watching the end of unipolar economic dominance. For roughly 30 years after the Cold War, the United States and its allies could use financial tools as weapons with pretty reliable effectiveness. Sanctions usually worked. Currency pressure usually created the intended crisis. Market access denial usually forced compliance. Not always, but often enough that these tools became the preferred method of exercising power. That era is ending. Not because America is weaker in absolute terms, but because the relative balance has shifted. Alternative systems now exist. China has built parallel financial infrastructure, specifically designed to operate independently of Western systems. Realize this transition was happening until they look back in 5 or 10 years and see the turning point clearly in retrospect. But you're seeing it happen right now in real time. The question is what you do with that information. How does it change your understanding of where to invest, what skills to develop, what risks to prepare for? Those are deeply individual decisions that depend on your specific circumstances, but they should be informed by accurate analysis of what's actually occurring, rather than comfortable narratives that don't match reality. 2026 is shaping up to be a volatile year. Commodity prices will likely surge in multiple categories. Currency markets will remain unstable as these larger structural changes continue. Trade patterns will keep shifting as countries adapt to new realities. Political tensions will continue affecting economic decisions in unpredictable ways. None of that is comfortable or easy, but volatility also creates opportunity for those who are prepared, who understand what's happening, who can see clearly through the noise. Stay informed. Stay skeptical of overly simple narratives from any source. Follow the actual data rather than the stories people tell about the data. Understand that economic warfare in a multipolar world produces complex, often counterintuitive results. And most importantly, recognize that we're not going back to the old system.